Poor planning drains profits. Running an assisted living facility takes compassion, but sustaining one takes planning. The biggest drain I see among healthcare business owners isn't poor revenue, it's poor planning. Hi, I'm Larry Davis, founder of Tax Help. We help assisted living and healthcare business owners clean up their books, reduce their tax bills, and finally take control of their finances. Now let's be honest, running an assisted living facility isn't easy. You're dealing with staffing, compliance, resident care, and constant expenses, and somewhere in between, bookkeeping and taxes get pushed to the bottom of the list. But here's the problem. That delay, that lack of planning, it's costing you thousands every single year. Late tax preparation, no forecasting, ignored reviews. These small habits quietly drain your profit little by little until tax season becomes a financial emergency. You wouldn't wait for a resident's health crisis before acting, right? So why wait for the IRS to send a notice before reviewing your finances? The truth is, the IRS doesn't reward hard work, it rewards organization. When your books are clean, your taxes predictable, and your financial systems reviewed consistently, you stop surviving tax season and start controlling it. That's the shift, because financial stress doesn't come from taxes, it comes from poor planning. When you build the right systems, you're not reacting to surprises, you're forecasting outcomes, you're protecting your profit, not watching it disappear into penalties and overpayments. So if you've been working hard, but your numbers still don't reflect your effort, it's time to change how you plan, not how you work. Let's talk about the real issue behind it all. Poor planning drains profits. Last minute tax prep. In assisted living, everything runs on structure except, for most owners, their tax planning. Waiting until tax season is like waiting for an emergency before checking a resident's vitals. One facility I worked with scrambled every March, rushing receipts to their CPA and ending up shocked by another oversized tax bill. After shifting to a year-round review, scheduling monthly checkpoints and quarterly projections, they started controlling their numbers instead of reacting to them. Within a year, they reduced their tax liability by 25% and finally stopped dreading April. The truth is, tax planning isn't an annual task, it's a continuous system. And in assisted living, structure is what saves both lives and profits. Mistake number 2, ignoring cash flow. Cash flow in assisted living can swing wildly when census drops, payroll spikes, or an unexpected repair hit. Without forecasting, owners are constantly caught off guard, relying on gut feeling instead of a plan. I've seen facilities borrow from next month's tax fund just to cover today's payroll. But when a 120-bed facility adopted a rolling 12-month forecast that tracked revenue, payroll, and emergency reserves, everything changed. They stopped running in panic mode and built a financial cushion that carried them through the next year's tax season with confidence. Knowing what's ahead means you decide where your money goes, not the other way around. Mistake number 3, failing to separate tax funds. Most healthcare facilities make the same mistake, using one bank account for everything. That's like mixing patient medications. Eventually, something goes wrong. I worked with a care home that always ran short when quarterly taxes came due. We set up an automatic transfer. 15% of every deposit went straight to a separate tax reserve account. 6 months later, tax time arrived, and for the first time, they didn't owe a dime out of pocket. It's a simple system that creates discipline without effort. In assisted living, structure prevents chaos, and separating tax funds is one of the easiest ways to stay in control. Mistake number 4, skipping quarterly tax reviews. In healthcare, prevention saves lives. In business, it saves money. Yet, most assisted living owners meet their CPA once a year, missing the chance to make crucial adjustments. One facility that started quarterly financial check-ins discovered they had been overpaying nearly $8,000 in estimated taxes. By realigning projections before year end, they redirected that money into staff retention bonuses, turning waste into reward. Regular reviews create awareness, and awareness leads to control. In assisted living, what you monitor improves, and your finances are no different. Quarterly checkups aren't extra work, they're how smart owners stay ahead. Mistake number 5, neglecting expense categorization. Mismanaged expenses are silent profit leaks. Assisted living facilities often lump everything together, from supplies to staff meals, under one category. That chaos hides deductions and confuses reporting. One client's books looked fine on paper but missed over $22,000 in potential deductions. We restructured their chart of accounts into clear categories: care delivery, administration, and facility maintenance. Suddenly, every expense had a purpose, and their tax return reflected it. Proper categorization isn't bookkeeping fluff, it's the backbone of smart tax planning. In assisted living, every detail matters, whether it's patient records or financial data. Clean books mean clean savings. Mistake number 6, overlooking tax-efficient payroll. Design payroll is usually the largest expense in assisted living and the most overlooked opportunity for savings. I once worked with an owner who paid everyone the same way, including herself, unaware she was overpaying thousands in payroll tax. We adjusted her structure under an S Corp, balanced her salary with distributions, and reduced her annual tax by $9,200. The change took place in one meeting. Smart payroll design isn't cutting corners, it's cutting waste. When you pay strategically, you reward your team, protect your profits, and put more quality back into care. In this business, every dollar saved on taxes is a dollar invested in people. Mistake number 7, not leveraging depreciation and asset planning. Every piece of equipment, renovation, or medical bed holds hidden value in the form of depreciation, but most owners never claim it correctly. I reviewed the books of one 30-bed facility and found they hadn't updated depreciation schedules in 5 years. After documenting every capital upgrade and applying cost segregation, they unlocked $45,000 in deductions. That's money that was already buried in paperwork. In assisted living, your assets are more than tools of care, they're tax-saving opportunities. The key is tracking upgrades with the same precision you apply to patient care. If it serves your residents, it should serve your bottom line too, excluding owner benefits and retirement plans. In caring for others, most owners forget to care for themselves financially. Many pay everyone else first and neglect their own retirement or benefit deductions. One facility owner earning $200,000 annually redirected $30,000 into a defined benefit plan, immediately reducing her taxable income while building long-term security. Within a year, her effective tax rate dropped and her retirement balance grew. Owners deserve to benefit from their hard work strategically. Treat your compensation like an investment, not an afterthought. When you take care of your financial well-being, your facility gains a stronger, more focused leader. Mistake number 9, ignoring year-end tax strategy meetings. The end of the year is where most tax savings are won or lost. But many assisted living owners are too busy managing staff schedules or compliance to plan ahead. One operator skipped her year-end review and missed a simple opportunity to prepay vendor expenses, losing a $6,000 deduction. The next year, we set her up with a November tax huddle, adjusted expenses before deadlines, and saved 17% on her final bill. Year-end planning isn't about rushing paperwork, it's about finishing strong. Just like closing a care report, it's your final review before results are locked in. Mistake number 10, operating without a financial system. Behind every overpaid tax bill is a disorganized operation. I've seen assisted living facilities making millions, but drowning in confusion, missing reports, duplicated expenses, and no clear data. One owner I helped went from panic every April to complete control after we built a simple rhythm: monthly reconciliations, categorized expenses, and quarterly reviews. Within one tax season, she could finally see where her money was going and why. Systems don't just organize numbers, they organize your mindset. In assisted living, consistency is the difference between burnout and balancing. Every assisted living owner started with a mission to care for people and build something meaningful. But without financial planning, that mission gets buried under tax stress, missed savings, and burnout. Poor planning isn't about lack of effort, it's about lack of structure. The facilities that thrive don't work harder, they work smarter, with consistent reviews, clean books, and proactive decisions. You can't grow what you don't measure, and you can't save what you don't plan. Start treating your finances like your care plans, monitored, measured, and managed. Because in this business, structure saves more than lives, it saves profits. If you're an assisted living facility or a healthcare business owner overwhelmed by tax confusion or financial chaos in your business, subscribe right now. Every week I share real strategies to legally help you reduce what you owe, Also, we'll send you our 10 tax strategies for assisted living and healthcare businesses to reduce their tax bill just for liking this video.